We saw real risk-on sentiment from March 23rd until the beginning of June. It kind of leveled off, popped up again, and now it seems to be coming off. How much of this is related to COVID and how much of it is related to other issues?
Well, the bond market tends to look through a lot of the near term. I guess you could say the same for stocks as well, Matt. But with bonds, the pricing mechanisms are quite robust to the interest rate expectation, whilst I guess with stocks there are many more factors. I've never believed that we had anything more than a rebound, and we have to be very careful not to confuse evidence in the fast data of rebound with recovery, because rebound is not recovery, and recovery has to get back to the previous level. Now, I'm sure you're aware of this. It's going to be very difficult for the next couple of years to see a full recovery back to the previous level. So it's quite noisy, the data, and a more realistic view looks ahead to next year and the year after, and that's why bonds are behaving in such a calm fashion. The trading ranges are very tight, the volatility is very low, and for the stock market, I think it moves around on the news flow, and as you know, it's driven by some of the themes that are going on in the sectors.
Yeah, good morning to you, Stephen. So rebound is not recovery. You make that point very clearly. What does that mean then for your expectations for US Treasuries and where we head from here? What kind of, how long out into the future do you expect Treasury yields to remain so low?
Well, believe it or not, we try and forecast 5 years out into the future to try and forecast 1 year into the future. And our view is that this year the yields will be 50 basis points by year end for the 10-year Treasury. That's an old forecast. I look at the Bloomberg consensus, and I think the number for the median is close to 100 basis points. The forward is just above 70. So our forecast is probably the lowest one you've got. That's because we see rates staying low for a very long time. And I find it very difficult to see how they are going up in the next few years. Now, other people have different views on this. And to me, the case for reflation and inflation risk, that has to be made. And as far as I'm concerned, it's very, very weak evidence at best. The extent of the demand shock is so great that all of the kind of supply side anecdotes we're hearing of potential cost push inflation just don't add up to be enough to outweigh the impact of the demand shock. Think about wages and the level of unemployment where the output gap is. How's this going to be closed at any time? It's going to take ages, Anna.
So what would you do to close it? What do you think we should hear from people like Rishi Sunak today, or, not him specifically, but governments and central banks in order to deal with this thing as well as possible?
Well, first of all, no one cares what I think, Matt. You should remember that. But the central banks...
We do.
Central banks are well served by giving an optimistic outlook. They're well served and somewhat complicit in the process. They have to talk up the recovery. They're hardly going to say, oh dear, it's not going to work, is it? We're all doomed. It's like Japan. They're not going to say that. So I'll look at the track record over the last 10 years, and I'll look at the forecasts that have been made, and I'll make a judgment based on the form. The form isn't very good. There has been an over-optimism bias for a very long time. So more of the same just doesn't do it. I think what we need is a dose of realism and some honesty. The truth is we're in this for the long haul. And that's why the bond market is priced more and more like Japan. You would have seen in one of those previous charts that everything has converged onto the bottom right-hand corner. That's US Treasuries coming down onto the Bunds, Gilts, and JGBs. That isn't wrong. That is a considered opinion of professional market investors and forecasters. Now, the central banks may wish for something else, But frankly, there's no silver bullet. There isn't any magic potion. Let's just be realistic. We're in for the long haul.
OK, and where does that leave the debate around yield curve control, Stephen? You talked about how a lot of these yields have already converged at very low levels. We have experience now with Australia and Japan with yield curve control and how they can shape their curves. Do you think that this is going to be a growing phenomenon as we look at what this does to Japan and Australia? Is this something that other central banks are going to be doing?
Yeah, so the chart that you put up there shows the 10-year segment, and the FOMC sat down to a presentation back in June, and we can see what they thought about that in the minutes. It was a little bit disappointing that there was lots of discussion about forward guidance and the past. Yes, they looked at the Australian 3-year yield curve target. They looked at the 10-year target in Japan. The only nugget insight I got out of the whole thing was that perhaps they're looking at bolstering the forward guidance with a commitment device, they call it. So that's referring to the idea of a short end yield curve target. So I imagine it could be up to as much as the 5-year, for example. Now that would make sense to me, but only a minority of the FOMC seem to be in favour. And I would argue for a risk management approach, to be proactive rather than reactive. And the price of failure is high because they don't want a situation where the market actually judges that there might be an inflation risk. As I said, there's so much uncertainty. It could be that they are fighting to keep the yields down. At the moment, there's a risk of complacency because there's no inflation expectation. It seems the market agrees with what I've said to you about low for longer. And so there's a danger of a kind of hubristic behavior where they actually believe they haven't got to do anything because the market's doing all the work for them. I would say putting in place some kind of mechanism to stop the yields going up becomes imperative because the challenge in the future is the debt overhang. There's just too much debt. How do they manage the debt over the long term? You asked me for a solution. I don't really have a single silver bullet, but I know that the imperative of the central bank and the governments is to manage the debt overhang. They may talk about inflation targeting and growth and what have you, but the reality is they have to manage the financial repression for the next decade or so.